A chart may appear flawless, but without a clear exit strategy, the trade can still fail. This oversight can transform a minor error into a significant loss, and it happens more frequently than you might think. The challenge arises when the focus is solely on finding the ideal entry point while neglecting exit strategies and risk limits. Getting lost in details fosters market myopia, causing traders to lose sight of the broader environment and plan. Without a comprehensive view, even the most diligent trader can spend weeks researching only to be caught off guard by evident context. The resulting cost includes erratic outcomes, emotional responses, and the feeling that skill vanishes whenever market conditions shift. A trader might invest countless hours testing entry signals, but fail to outline exit indicators or maximum loss thresholds. When the market moves against them, they may freeze or resort to improvisation, turning the trade into a stressful gamble. In the upcoming sections, we will develop perspectives, cultivate discipline, assess personality compatibility, establish risk rules, and adopt recovery practices. This video draws inspiration from Stock Market Wizards by Jack Schwager, so be sure to subscribe for more solid trading principles. A comprehensive perspective integrates entries, exits, risk and context into a single, cohesive decision-making process, instead of treating them as separate tasks. This approach is effective because every trade exists within a sector, shaped by market sentiment and informed by a subsequent action plan. Ignoring context can lead to an unexpectedly risky environment, even when the research itself is sound. Undefined exits can cause the same entry method to yield wildly varying results based on a trader's hesitation under pressure. One trader may analyze promising companies yet overlook that the entire sector has already surged, raising risk levels. Another may refine timing strategies while neglecting the more challenging task of determining exit points and loss limitations. A better strategy is to view trading as a cohesive system, where each component reinforces the others. This system begins with understanding the market and sector first, then evaluating what is known versus what remains uncertain. Craft a one-page plan that clearly outlines entry criteria, exit strategies, and a maximum allowable loss per position. Before executing any trade, revisit that plan to ensure every aspect is addressed, including the exit strategy. Discipline is the common trait that transforms a good idea into consistent practice across varying market conditions. This discipline unfolds in two stages: develop a strategy and plan, and then adhere to that plan without deviation. Absent discipline, a trader may alter rules mid-trade, rendering their record too chaotic to learn from effectively. With discipline in place, results indicate the strategy's effectiveness, as execution remains consistent regardless of mood or fear. A solid plan should anticipate contingencies, turning surprises into predefined responses rather than last-minute decisions. For instance, when an error emerges, the correction should become a lasting rule, rather than a stopgap solution. This method minimizes the urge to chase every new opinion, as the process already encompasses essential considerations. It also bolsters confidence, since true success stems from consistently following a tested plan, not merely from relying on predictions. Select a strategy that aligns with your investment timeline, establish clear rules, and consistently track each trade in the same manner. Review your trading log on a monthly basis, revise your plan as needed, and commit to implementing the updated version without deviation. Prioritize risk management as the primary focus, as making mistakes is a typical experience, even for the most successful traders. The aim is not to eliminate losses entirely, but to keep them manageable so that your decision-making remains clear and focused. Larger losses can trigger fear and lead traders to panic, freeze, or ignore exit signals when they arise. Keeping initial position sizes small alleviates that stress, ensuring that one trade does not control your entire portfolio. Many traders opt for predetermined stop-loss levels so they know exactly when to exit before entering a trade. Others choose to quickly reduce their position when uncertainty arises, effectively halving their exposure while retaining flexibility. These approaches foster a consistent trading process, as small losses enable you to maintain discipline through extended trading sequences. While diversification can mitigate risk, remember that correlations among stocks mean it cannot substitute for well-defined loss limits. Create a risk rule that establishes a maximum loss per trade and combine it with position sizing that adheres to this rule. If solid risk management and calm execution resonate with you, subscribe for more actionable frameworks you can implement right away. There is no singular path to success. Attempting to replicate another trader's strategy can lead to failure, even if their rationale seems flawless. Performance improves when your method aligns with your personality, as comfort enhances patience and diminishes impulsive changes to your strategy. Blending different trading styles can create tension, such as feeling the pressure of day trading while managing a long-term investment strategy. A well-defined trading style also aids in making risk decisions, as acceptable drawdowns can vary significantly between short-term and long-term strategies. One trader may prefer to achieve small gains with a high win rate, while another may tolerate numerous small losses in pursuit of bigger wins. Both methodologies can be effective, but only if the rules align with your emotional comfort level regarding loss and the duration of your patience. This reinforces the importance of a holistic approach, ensuring your method, time frame, and risk controls work in harmony. A clearly defined style strengthens discipline, because it becomes easier to adhere to the plan during periods of uncertainty. Identify a trading style you can commit to for the long term and clarify what constitutes a normal loss within that framework. Disregard methods that contradict your temperament and dedicate yourself to practicing your chosen approach until it becomes second nature. After experiencing a significant loss, recovery is quicker when your focus shifts from past losses to your current actions. Worrying about recovering from a loss adds unnecessary pressure, so it's wiser to concentrate on the present reality. Setting a revised target can minimize feelings of frustration, as a realistic goal promotes consistent decision-making and safeguards your discipline. This strategy also helps avoid revenge trading, where traders take oversized positions in an attempt to erase losses quickly. A trader who is facing a mid-year setback can assess what actions can be taken this week and this month to improve performance. By concentrating on what you can control, the mental strain lessens, allowing you to focus on execution rather than self-criticism. This ties into effective risk management, as smaller positions and clearly defined exits allow for a smoother restart. It also relates back to maintaining the right mindset, since the focus should be on executing each trade effectively rather than narrating past experiences. Establish a short-term process goal, such as adhering to your stop-loss limits and position sizes for the next 20 trades. Continue with this approach until your confidence returns, and only then think about increasing your targets or exposure. Remember, the objective is not achieving perfect predictions, but creating a process that promotes consistent decision-making regardless of wins or losses. This consistency is achieved by viewing the entire landscape, aligning your strategy with your personality, and safeguarding your capital with clear limits. Start by assessing the broader market context, then establish exit strategies and risk parameters before making any trades. Next, practice discipline by sticking to your plan, tracking your results, and using any valid exceptions to refine your rules. Over time, minor losses will lose their sting, as proper position sizes and stop-loss orders keep any individual mistake manageable. The outcome is enhanced learning from each trade, reduced emotional turbulence, and a resilient strategy capable of weathering years of uncertainty. Choose one trading method, document your entire strategy, and determine a maximum loss that you can handle without panic. Trade small enough to allow yourself to adhere to your rules without feeling stressed, and commit to executing your plan for a full month. As your process stabilizes, you will see measurable improvements, and your confidence will build from consistent execution rather than mere luck. If cultivating a steady trading process is important to you, subscribe for more insightful lessons focused on trading strategies and risk management.